Okay, morning. Second, third, fourth, fifth, sixth attempt, I forget now. Not crouched down today, sat down on a child's chair so that I'm at the same level as the board. Now, technically I'm on my first day of paternity. You guys, some of you guys could be back at school, I think, this week, so good luck with that. Today we're just going to flash through 1.3.2, I think it is, which is essentially revenue, costs and profit. In year 10, it's pretty much what are the differences in some basic maths. Nothing overly complicated. But the first one, looking at my notes, is revenue. And that's the income earned by a business. And that is generated from the number of units sold multiplied by the selling price. So if you sell 10 items at £10 each, that's 10 times 10, that is your revenue. That is as complicated as it needs to get. It doesn't take into account costs, so you can have an organisation that seems to be doing really well with revenue, but something's happening with its operations, the way that that business runs. And if you look a little bit deeper into it, its costs, the next thing we look at, are causing problems within that business. So as a business gets bigger, you would expect the quantity sold multiplied by the selling price to go up, and so as that company gets bigger, then revenue goes up. But a badly arranged or organised or led organisation can see that as the sales go up, as the selling price might remain the same, or that could go up, or depending on what's going on, but multiply those two together and you see revenue go up. But if they've got bad management, bad operations, bad procedures, old technology, whatever it might be, they could see that costs go up, and sometimes as you grow, your costs grow faster than your revenue grows. So, for example, Fatface has very good revenue, but they aggressively bought locations, rented locations, and so their costs went up. So they've got a lot of debt, they've got a lot of costs to maintain or survive. Remember, if we want to objectives in the previous lesson. So they've got to be careful. They have good revenue, but their costs are also worrying. But costs are broken down into two types of costs, which I haven't really written up there. I've written them, but not said what they are. You've got fixed costs and variable costs. What they are is in part in what they're called. Fixed costs are fixed, variable costs are variable. What they are fixed or variable against is the number of products that you produce or sell. Nothing else. Economic conditions, annual rent increases. Yeah, rent can change, but it still is fixed in the sense of things, because your rent tends to be agreed on an annual basis, and then it's going to change. But what we mean by fixed is that if I produce 10 items, 100 items, or 1,000 items, the rent of my little factory remains the same. It doesn't really matter. It's the same factory. I'm either under capacity, not producing as many goods as I could, lots of spare space and that sort of stuff, or I'm at full capacity, or even over capacity. But my rent remains the same. Salaries are fixed. As I get a salary, wages are variable. So someone who works at KFC or McDonald's will have a wage. The more hours they work, the more they get paid. Me with a salary, it's fixed, irrelevant of how many hours I work. Variable costs, as it says on the tin, they change with the number of products you produce. So the more you produce, you'd never guess, but your variable costs go up. The less you produce, or the fewer items you produce, the lower your variable costs will be. So if it costs you £5 per item to make, one item, your variable costs, £5. 10 items, 50 quid, you get the idea. In my notes, just checking, so variable costs, it's got listed, factory labour, if they're getting paid a wage, not a salary, raw materials, running machinery, that sort of stuff. So a lot of companies during the pandemic will have tried to bin off as many of their variable costs as possible. Fixed costs like rent on properties, there's not a lot they can do about that, but they can get rid of variable costs like wages, although salaries as well, and that's where the government's been paying 80% of people's wages to help companies with their variable costs so they don't have as many outgoings. Going down my list, something in regards to costs which the examiner is really hot about are interest. So when we talk later on about sources of finance, bank loans and stuff are always an easy go-to. But the downside to bank loans is you've got to pay interest. And in this area is how you calculate interest on loans. So I have a number of debts, and I always balance out my ability to pay with how much am I paying in interest. On our basic sort of family loan, if that makes sense, I'm paying 2.9% interest. Now 2.9% means on 7.5 grand I'm paying back probably 7,830 quid, something like that. It's costing me about 300 quid to borrow that amount of money over 3 years. The cost is low, keeps me happy. But you might be asked to work that out in the exam, and so you need to know what the total repayments are. So if it's 7.5 grand and you're told that that's going to equate to 230 quid per month over 3 years, 230, then it's, if you can remember how many months in a year and so forth, but 230 times 12 times 3, and that would give you your total repayment minus the initial amount I borrowed, which is 7.5 in my case, over 7.5, and you'd work out how much interest you're paying on that loan. Times by 100, it comes out as a percentage. But just be aware of that. It's one of those sneaky little things the examiner could ask. And then obviously you've got profit. Now profit is your revenue minus your costs. So to work out profit, you've got to have understood the previous two issues. It's nice and simple again. Looking at my notes, you're going to get a question with a little bit of maths in. The only thing you've got to remember is that they tend to be a period of time, so 12 months. In the world of business, that tends to be from April to April. April to April is, or April the 1st to the end of March, is a financial year. And that's when you calculate profits, that's when you compare profits and those sorts of things. But a nice simple unit, it's just that it's maths, and that freaks a lot of you guys out. So just to conclude, or just to go over it again, what you guys need to understand, that costs are things leaving the business. Revenues are things coming into the business. Revenue is quantity sold multiplied by selling price. Total variable costs, so those are the things that change with output, are the number of units sold multiplied by the variable cost per unit. Before I've done an example of that, but they might do it in a breakdown of, teddy bears, 50p for 2 bugly eyes, 50p for the stuffing, £1 for the skin. You don't put teddy bears in skin, do you? But you know what I mean. Fluff, skin, I don't know. You add all that up, and if you're making 100 teddy bears, you multiply it by that, and that gives you your total variable costs. Total costs is your variable cost plus your fixed costs. So you've got to be able to differentiate between the two, which ones are variable, which ones are fixed. And you might get a case study with a question that might give you some clues. My mobile phone bill is fixed because I pay a monthly fee. Some people on pay as you go, that would be variable, I guess. I've just talked about that one. But obviously up there, profit is revenue minus costs. Nice and simple. Hope that makes sense to you. I'll let you get on with your week.